Dear Excellencies, colleagues, students and friends, let me very warmly welcome you all to the second event in our lecture, Hungary in the Spotlight. I'm really delighted that you turned out in such big numbers, and it's a long time I haven't seen crowds that were standing and not finding a chair. So I hope you still find a chair over there. Let me shortly introduce the topic. Hungary finds itself in difficult economic times and in economic difficulties, and it has done so for quite some time. In East Central Europe, what stands out is that it hasn't been performing well for the last decade, probably in terms of growth, and that it has accumulated a lot of public and private debt. And let's admit, it's not a good time to be in debt right now, right? Markets are jittery. The European political elites look at each country whether it really fulfills austerity, and credit is scarce. So I think all of us have been worrying quite a bit how the new government will cope with these economic difficulties. Most intriguingly, at least for me as an observer, is how Hungary deals with its debt problem and the relationship to an IMF. I may be the only one, but I guess I'm not the only one who has some sympathy for a government that tries not to have the IMF interfering in domestic policies and domestic politics. But I'm not entirely sure whether unorthodox economic measures, especially as the government pursues it right now, are really the way out. Also, I have lost a little bit track whether Hungary is before or after the IMF. So our panel suggests life after IMF or Hungary after the IMF. But then there are, of course, signals that Hungary actually might just be entering before a new agreement with the IMF. So in short, there are plenty of puzzles to address here. What to do about the debt, where does it come from? What to do about Hungary's growth, what is really the economic problems that should be addressed, and so on. And I am pleased to say that we have a very high-profile panel to deal with these questions. Let me introduce you the speakers of tonight. To the far left, but this is not a political comment here, is Ivan Zeleny. He's a William Graham Sumner professor of sociology and also professor of politics at Yale University, and he is also foundation dean of social science at New York University in Abu Dhabi. He's a sociologist, and he specializes normally not in debt problems, but in social stratification, gender questions of inequality, ethnic minorities, and so on. And I think this will provide us with an extremely interesting view on economic issues, more interesting than some of the economists would be able to deliver. Some, not the ones sitting here are excluded, of course. Ivan Zeleny has published widely. The most recent book is How to Become a Billionaire, which came out in 2010 with Budapest Covina Publishing House. He also published recently Patterns of Exclusion together with János Ládányi, which came out of Columbia University Press in 2006. He won numerous awards and prizes, among them the President's Award of this university and also the Karl Polanyi Prize from the Hungarian Sociological Association for the book Patterns of Exclusion. Next to him, on the center left, again, no political comment implied here, is László Csaba. He is professor here at Central European University of International Political Economy and also at Corvinus University of Budapest. He is also a member of the Hungarian Academy of Sciences, and he was president of the European Association for Comparative Economic Studies. László Csaba is especially interested in the political economy of the new Europe, and he is an astute commentator of current Hungarian affairs. He is the author, I think, of 11 books, editor of 6 volumes, and more than 100 articles. And his recent books include Crisis in Economics and The New Political Economy of Emerging Europe. Both of them came out with Academia and Kluva publisher. And finally, to the right, again, not a political comment, Péter Mihály. who is a visiting professor of economics at Central European University and the head of Department of Economics of Finance at the University of Pannonia in Veszprém. He is also a honorary professor at Corvinus University and an external research fellow at the Institute of Economics of the Hungarian Academy of Sciences. He held a number of advisory positions to previous Hungarian governments and was also an assistant secretary of state in the Ministry of Finance in 1997-1998. Professor Mihai published widely on health issues, healthcare issues, and issues of privatization. And I'm really looking forward to hearing his view on Hungarian economic problems right now. Let me just shortly tell you about the format. So each of the speakers, and we start again at the far left, will get 10 to 15 minutes for an introductory statement. I will then ask each of them whether they want to comment on each other before opening the discussion to the floor, and then we will have several rounds or only a final round of concluding remarks, depending on how active the debate goes. So, Ivan Zeleni, the floor is yours.
Thank you very much for inviting me. I came here for a PhD dissertation defense, and then the political science department approached me whether I would be available to give a lecture on the sovereign debt issue in Hungary. Well, I said I really am not ready to give a lecture, but you know, if we are sitting around the table with some other people, I would not mind to have a conversation about it. So I came a bit unprepared for a pretty large roundtable gathered here today. Well, you know very well, I'm not an economist and I'm not living in this country, so my learned colleagues know much more about the Hungarian economy and economics than I do, and most people in the audience probably also do more. So I think if I have any advantage, it's the advantage of the distance. That I have a somewhat more distant view on what is happening in Hungary and in the European Union in general. So let me start with a provocative statement, and I'm sure that at least some of my learned colleagues will disagree with me. Actually, the sovereign debt issue is not a big deal in Hungary. You know, 80% of the GDP in sovereign debt is not trivial, but almost trivial. It's around the average of the European countries. If I am right, the sovereign debt in Japan is 200%. In the United States, it's about 70% and rising. So in itself, the sovereign debt issue is not a very big deal in itself. The question is, if it is not a big deal, why the yield on Hungarian bonds are too high, and why insurances on Hungarian bonds are skyrocketing. There is some doubt, right, in Hungary's ability to manage this otherwise reasonable level of debt. But this is my starting point, right? The sovereign debt itself is not a very big issue. So then let's move on to a second provocative statement. I think to make a very big issue out of this debt is largely a political gesturing. So if it is true that the sovereign debt is not a big issue, in fact, increasing this debt in the year 2000 is also not a very big issue, right? Well, it increased from something like 50% to 80%, and it can be debated whether it was the right policy or the wrong policy between 2000 and 2008. Békési wrote an article recently, and I think he made a very good point. When an economy is growing, then you reduce your budget deficit, and if anything, you reduce your debt. It looks like the problem in Hungary between 2002 and 2006 was that the economy was actually growing between 1996 and 2006, and Hungarian debt was increasing, right, when the economy was in a good shape, and there was a big budget deficit. Well, I think this is quite correct, and actually Békési suggests that the problem Hungary finds itself now, that it actually has to implement austerity measures when the economy is down, and therefore there should be a larger budget deficit and more state expenditures. This is the problem. It has to implement austerity measures when it could have implemented austerity measures. It did not. Now, I think this is a good point. Except, I think Békési does not quite address the issue that Hungarian economy had a structural problem. And I think this is why the yield on Hungarian bond is so high due to a structural problem. The lack of prospect of growth in the Hungarian economy and inability of the Hungarian economy to manage this growth. So in itself, one would say, though, the policy to operate with a budget deficit from 2002 and 2006 at first instance might not have been too smart. I would say if it would have done the right way, it could have yielded to the right results. If inexpensive credit was available to borrow that credit and to invest and to put the economy on a lasting, sustainable growth trajectory, could have worked quite well. So in this sense, the Megyesi-Gyurcsány program in 2002 to have a turn in a jóléti rendszerváltás, to turn around welfare for the country, might have been the right strategy to do. It would have been done the right way, namely to create jobs. And now this leads me to the next point, that I think the underlying most important problem of the Hungarian economy, and probably it's also the problem of Southern European economies like the Greek or the Portuguese or the Spanish economy, is insufficiency of jobs. And that has been a problem of the Hungarian economy basically since the transition to the market economy. The transition devastated the Hungarian job market. About a third of the jobs were lost. And unfortunately, during the decade of growth between 1996 and 2006, it was basically a growth without jobs. So therefore, if between 2002 and 2006, jobs would have been created, creating a sustainable growth on the long run, the Hungarian economy may not be in such a deep problem. So I think the reason why investors have grave doubts in the Hungarian bonds, beside mistakes what government policy does, is that the factors of production in Hungary are not sufficiently used. The data vary, it depends whom you read. Roughly about 55% of the people in economically active age are employed. This is about 65% in Europe. It's about 75% in the United States. So there is obviously a big problem. So I think I was always a great admirer of Bill Clinton, I have to confess. Bill Clinton's last book, Back to Work, seems to be the right recipe for the Hungarian and many European economies, right? What is needed, the creation of jobs. This is actually a very big challenge, because how you can create jobs with austerity measures. Austerity measures, as we have seen in Portugal and Greece, is destroying jobs and actually bringing the economies further down the road. Well, some people will suggest, I think we exchanged with Peter some emails about this. Well, it's exaggerated because there is a large informal sector, which actually people do find jobs and incomes. Well, it's probably true, though who knows how much it is, whether this is more or less than it was before the transition to market economy. And, to do it through the informal economy is the bad way to do, because it does not generate the tax revenues what the economy needs in order to manage the sovereign debts. So anyway, my crucial point is that the underlying basic problem of the Hungarian economy, and probably the Southern European economies, is lack of jobs, and that is why there is little trust among the lenders, whether Hungary will be able to meet its debt. And that's why Hungarian economy, with this relatively modest debt, is on the verge of bankruptcy. Let me also make another point, that beyond the ineffective use of the major productive factor, labor, there is another big problem for the Hungarian economy, and again true for most of the Southern European and many European economies, and that is demography. I just take as granted the wisdom of economists I am reading. I think it's normally expected that about one income earner supports one person in pension. Well, the Hungarian economy is far from this, right? 1 to 2 it would be a very good estimate for the Hungarian economy, and that in itself is unsustainable. Well, very hard to, both questions are very hard to deal with, right? How you deal with the insufficient use of the major productive factor, labor, and how you deal with the question of demography. What can I say? I don't envy Hungarian policymakers. I think they are facing tremendous problems, and whether the Hungarian economy can avoid a default, sovereign default, is something what remains to be seen. Like we even don't know whether the Greek economy will be able to avoid a sovereign default. I should add here. I would like to add here with a very brief note that where sovereign default is not an unusual or rare event. In the last 30 years, there were 120 sovereign defaults in the world. Well, that's true. None of the developed economies were in sovereign default in the last 30 years. Well, in the last 200 years, almost all major economies had sovereign defaults. I think the major issue is how sovereign defaults can be handled. Some sovereign defaults are managed better, others are managed very badly, just like corporate defaults, right? Corporate defaults can be managed well and can be managed very badly. We just have seen in Hungary a very badly managed corporate default, right? Malev. Well, if Hungarian economy is moving into a sovereign default like the corporate default of Malev, then the Hungarian economy is in deep trouble. Whether any default can be managed appropriately, like I think the Argentinian default, assumedly, was quite well managed, that remains to be seen. Well, the Argentinian default in 2002 was actually pretty well done. They were also very lucky. Just as they declared default, the price of the soybean went through the roof, and Argentina was on the right track. On top of this, Argentina did something very different from what the Hungarian government did. They were talking very sweetly to IMF and very sweetly to the lenders. They kept assuring them, don't you worry, we are getting into default, but we will repay you, right? And therefore, they created a level of trust in which they actually could get out of the default quite well. And I don't think that these two conditions for a default are all that promising for the Hungarian economy right now. Thank you.
Thank you very much.
Thank you. One of the axiomatic things is that if you have a sociologist and an economist in the same room, they should not agree on anything. And it shows already what kind of foul company you have been invited to, that I tend to agree with most of what Ivan had to say, especially in terms of the overall picture, namely that if an economy is growing per se, growing debt is not a problem, that the debt ratio of Hungary is nothing truly dramatic. If you just need the number, the Hungarian debt at the end of 2011, debt ratio to GDP is 80.3%, the Eurozone average 87.9%, so that's not a catastrophe. And the only point in which I'm truly in disagreement with Ivan is the overall assessment of those last minutes, what he was comparing Hungary's situation to the sad story of Malev. The Hungarian economy is not in a stage of default. Hungarian economy is not in an immediate financing crisis, unlike under the Gyurcsány government in October 2008, unlike in 1990 when the new government was formed, unlike in 1981 when Hungary was truly on the verge of default. I mean, this afternoon the Center for State Management was actually selling twice as many of the Hungarian Treasury bonds as they were planning, and the spread on the money that had to be paid for it, 7.27%, is of course still very high, but it's nowhere close to the 11% that was experienced only a month ago. So, I mean, these profit requirements on the bonds, the recoupment trends are already improving. Nothing yet has been produced. The negotiations with the IMF have not even been started. Also, if one looks at from the point of view of public finance, the reserves of the National Bank are about enough to cover about 6 months of imports, which many people consider to be actually too high. And the central bank is often being criticized of sitting on too big of a basket of money. Of course, you cannot eat the cake and have it. You cannot have the security of your funding and not to pay high prices for keeping the reserves. So I think the National Bank of Hungary very correctly appreciated the risks in the situation, which is to a very large degree determined by the panic on international financial markets, where Hungary is not a major player. Hungary is an absolutely minor player. What is happening in Greece is decisive. What is happening in Hungary is to a large degree a derivative. What is happening to Italy is decisive. What is happening to Hungary is a derivative. Whether the Obama administration manages to stop the explosion of public debt is truly a fundamental matter for the global economy. Whether the Hungarian public debt is likely to decrease along the lines set by the basic law of the country is a matter of cosmetics rather than a matter of global economic consideration. So I think it is important to see that Hungary is not, for the time being, in an immediate debt crisis. Hungary is one of the many periphery countries which are being hit by the current panic on the global financial markets, which have a number of reasons, which can be a subject of a separate talk, how it came about, how to solve and all that. And perhaps we can make one occasion on the global financial crisis and why it hasn't been sorted out the way many of us were hoping for about 2 years ago. It will sort out itself. Is a different matter. From the point of view of the Hungarian indebtedness, it's just a matter of fact that since about June 2011, the tide has changed on the global capital markets, and funding conditions for any country on the periphery have become very weak. And that is the problem, and rather than the fundamentals, any of the fundamentals you care to mention is something sustainable. Second point, as a consequence, I quite agree with Ivan that Hungary's major problem is not that much the indebtedness. The problem is a problem of growth, and growth of a number of indicators of all the fundamentals, starting with GDP and then the growth of jobs, and growth of this and that, of small business, and of number of corporations traded on the stock exchange, and one can go on and on and on. Hungary is in a growth dead alley, and that is the problem. Hungary stopped growing by the middle of 2006, and that is the problem, that it started much earlier, the global financial crisis. It did not go away with the global financial crisis, contrary to the claims made especially by the so-called independent commentators, the financial analysts, who believe that if in your model you get the external shock out of the model, then you are back on track. But the model cannot be more clever than the model builder, and as long as you have a simplistic model, then of course, if you have only external shock in the model and you get it out, then you are back on track. The problem with Hungary, there is no way to be back on the previous track, on the debt-financed growth, because that type of growth is constrained by a number of structural components, including, very importantly, the very low level of economic activity and including problems of employability, which have to do with the low level of output from the educational system, which allows people to, does not qualify sufficiently people for the jobs, and also because of the misalignment of the incentives, in which if you earn a certain transfer plus work in the irregular economy, you can be much better off than taking any formal jobs in the regular economy, and that is of course a problem for society and economy. So in short, Hungarian economy is not growing for a very large number of reasons, which can be a subject of a long talk. I think it's basically it has to do with the system of financial intermediation, with trust, with overspending, with lack of reforms major reforms over the past 15 years. So that can be a long thing. The thing is that we have a problem with growth rather than with debt. If only we were back to growth, that would not be a problem, and financing that would not really matter. And this, I think, is quite important, because as long as we try to manage both and meet via financial measures, short-term financial measures, then we solve one problem and create two, and we'll just remain on the road of stagnation. Third point, that for this reason, of course, getting in the IMF is always a bad news. Anybody who has studied the history of international financial institution knows that it's a sad event. The IMF is in a way a grave digger. If they are already invited, then some major catastrophe has already happened and needs to be taken care of. And of course, there is always an alternative to let the body there, and I mean, then somehow nature will take care of itself, but it's still better to have it in an organized and ritualized manner, and this is the role of the grave digger, which in our case is the IMF. We know that the grave digger has certain narrow mind, so it doesn't really care about prosperity and about breeding new children and happy marriages and many other things. The grave digger has a very narrow mandate of managing the debt, and the grave digger for this reason is sort of narrow-minded, simplistic, but has a very clear mandate about what is to be done, and that is to be done in a professional manner. That can be expected of them. Why do we need the IMF? We need the IMF because the Hungarian government is a very low level of, enjoys a very low level of credibility, and because there is a lack of communication between the government and the markets. The Hungarian government needs an external seal that they are doing the right things. Even if they are doing the right things, they are unable to communicate. As long as they are unable to communicate, they do not make the impression. And even if the numbers are okay, the impression is that somehow those Hungarians are somehow dodging the right things. And even if we have a very tough austerity, as in this year's budget, we get the comments from the European Commission that we are not doing enough. We are just in the middle of let's say, stagnation or perhaps in a recession, and then making a fiscal correction which includes a contraction of 2.5 percentage points of GDP. That, to be qualified as insufficient, is sort of misunderstanding of the fundamentals of macroeconomics. I'm a great believer of sustainable public finances, but would not like to see additional contraction to be brought about by additional fiscal stringency at times of recession. We can do it at times when things recover, and I think this fundamental improvement has already started. Of course, it also doesn't sell very well, for which reason we need the IMF. I would also think that the IMF needs good clients. I mean, as long as we had the Greeks, it's not a tall order to be better than the Greeks, so perhaps we can be a better client than the Greeks. I would expect, knowing the people in the government, that they have understood that without the IMF they are unable to sell the message, and they are unable to benefit on the stringency, sometimes on the brutal cuts they have introduced in the system of transfers and social spending, unless they have the external seal. So from the point of view of the Hungarian government, the willingness seems to be there, and I would also expect the same from the point of view of the IMF, because that's not a big risk to say, okay, the Hungarians are doing by and large the right things. Of course, on bits and pieces we can discuss and debate endlessly. So my third claim is that the deal is in the making. It will happen relatively soon. There won't be any radical or unusual kind of thing. This is why I brought this metaphor of the grave digger. The grave digger very rarely does something unconventional. It will be very sort of return to conventional economic policies about expenditure cuts and revenue raising and more transparency and less improvisation. There is nothing theoretically or practically too interesting in it. Now, my story is that why I suggested this title for today's discussion is that the real big deal is not about the IMF, but what comes after the IMF. After the IMF will come normalcy. Normalcy is, I mean, usual work days. I mean, when you no longer have the big event, you no longer have the funeral, and for this reason, you're back to normal. And then what remains are that the problems remain. I mean, the real problems, the serious problems, and that include problems of the welfare state, of which Ivan was already talking, and I would expect Peter Mihai to expand on that. We have the problem with social cohesion and exclusion, and low-level labor market participation, which Ivan was talking about, is just one of the many signs of that, but now we have also ethnic segregation and a number of other signs of disintegration of the social fabric, which can be extremely dangerous, way above the current indicators of the macro economy. We have very deep capacity to innovate. I mean, we have this mistaken idea of Hungarians being particularly clever and having given a lot of Nobel winners to the globe, which is true, but unfortunately, except for Szent-Györgyi, but latest in his time also, Szent-Györgyi had to migrate from the country. So from this reason, I mean, to be seeing ourselves to be innovative is in a way true, but we are innovative when it comes to not paying taxes or not paying public dues, but playing around by the rules. But when it comes to truly, I mean, the kind of technocratic innovation, what you have studied in macro, I mean, the embodied technological progress kind of thing, we are no longer as good as we used to be, and that is quite important. We should spend on that, and that's a long and complex matter. Sustainability, environmental, social, financial, number of other things is not around. And my final problem is what I see as a truly basic and issue which is not related or only in part related to the IMF is the very low level of trust in the Hungarian society, trust in everything. So trust in the other, trust in institutions of various sorts, and especially this institutionalized trust, lack of institutionalized trust is a major, major problem. We know from a large body of literature now, even economic, but previously sociological, political science, that the more sophisticated is a system, the bigger is the relevance of trust in getting the system motivated. In the well-known saying of Jenny Reich, you cannot get a policeman to each and every slap on the face, right? And the more sophisticated you are, the less you can get the policeman who would actually look at you and whether you are doing the right things or not. Not in finance, not in academic research, not in a number of other things. We have a very, very low level of trust according to all the surveys we have, Eurobarometer and others, and that creates an atmosphere in which non-abiding behavior, non-respect for the others and for property rights and for contracts and for civilized behavior is becoming the norm, and that is becoming self-propelling. And this is reflected in what Turkey Institute for Social Research was indicating, I think in their last year's report, that the value system of the Hungarians is converging not to that of Northern Europe, but to Southern Europe and Southeastern Europe, and this is not a promising sign, and the IMF is unlikely to have this type of problem. Thank you very much.
Thank you very much. I think it was a great order of speakers because indeed I'm going to speak about and start my presentation with a few numbers on the debt issue. And the starting point will be the same where Ivan and László started, but I will continue in the line of disagreement. Indeed, when you look at this, the size of the public sector debt, it's really not big. And you can say, like the previous speaker said, that it's no problem. You can finance it from outside, you can finance it from inside. That's in itself not a big issue. However, I will argue that, of course, there are many constraints to economic growth in Hungary. But my argument is, and I'm making it sharp to make it clear, that that is one of the biggest problems, which is really the constraint to growth. Because if you look at the total Hungarian gross debt, then of course you have to take into account that we have not only the public sector, but we have a business sector, the economy, which is very heavily indebted, 115% of GDP, excluding the banks. So it's a business sector which is heavily indebted. We have the households, which are also quite seriously indebted. I don't need to go into the details for those who are from the Hungarian public. It's a very serious problem that the Hungarian households are indebted up to the neck. Plus, we have local governments, which are also very seriously indebted. And therefore, these numbers are together make a big freezing impact on the economy, because every player is indebted. Now, technically, there are numerous alternatives how to refinance the Hungarian debt, how to roll over the debt. Of course, it is possible to borrow money from abroad in Forex, in dollars and euros and yens, and of course the banks are doing that. And once the banks are doing that, then of course they provide lending to Hungarian enterprises, to the SMEs and the households. This is what happened. The subsidiaries of the multinationals, the Audis and the others, of course they can borrow money directly from their mothers, and that works well. And of course, the public sector has various sources. The public sector can borrow money from the households. It can borrow money from the market, business, commercial banks, foreign commercial banks, both in foreign exchange and in HUF. And the possibility is also there to borrow money from the international institutions like the IMF and the EU. The problem is, and we don't have time to get into this, but I think it has been amply discussed in the last couple of months, that all these things are interrelated. So currently Hungary has access to the financial markets, the commercial markets, under the assumption that there will be an agreement with the EU and the IMF. So these are interlinked alternatives. There's a further complication that Hungary and every player on the game has to take into account, that this is not just borrowing as such, but even the Forex borrowing could be in Swiss francs and in euro and dollar and so forth, and it makes an enormous amount of difference what kind of borrowing facility, what kind of borrowing channels are used. And as again everybody knows in this room, there was a historical mistake, a historical unexpected development, namely that the Swiss franc and the euro departed, and all these players, the local governments, the Hungarian firms and the households, they all borrowed in Swiss franc, which is an additional problem beyond the sheer size of the debt. Okay, first conclusion, and that is very often forgotten, that this is the hot potato issue. It is not just the Hungarians are in debt, but the problem is what financial economists call an open currency position. So the problem is that we have these players here who generate most of their incomes in HUF, in Hungarian forints, and they have foreign currency debt to service. And that's the problem in itself, and merely shifting the debt from one Hungarian player to another Hungarian player doesn't change the country risk. So if the Hungarian government, the public sector, is taking over the burden of the households, and that has been going on, and forces the banks to take over the debt burden or part of the debt burden, that is good for the households, but from the perspective of country risk, it doesn't change anything. So this hot potato goes around, but from external point of view, it doesn't matter. Furthermore, if this is done in a provocative way, as it is being done, the unorthodox method, so the debt is burdened on the banks, the debt is burdened unproportional to the banks, and there is a demagogy against the financial sector, then actually it even deteriorates the perception of risk. And Hungary has now a very bad reputation as a debtor, very bad reputation as a country, which makes the whole problem much more serious than the underlying numbers in itself would say. So that's the first conclusion, that what is going on for the last 2 years is, of course, important, but doesn't change the picture, really. Now, there is another issue which is often neglected and often forgotten in the analysis, and that is that one issue is that how big is the total gross debt of a country, but the other question is, and that's the long-term growth and the servicing risk, what kind of assets the country has. What kind of assets the government has in terms of national bank reserves, what kind of reserves the business sector has and the households has. And if you look at the asset side and go for a calculation, and we want to see the net position of Hungary, the net international investment position, then we get a very surprising picture. Actually, among the 27 EU countries, Hungary is in the worst position. So the problem is not only that we have debt, because other countries have debt too. For example, the UK or Germany or Belgium. These countries, Belgium has much higher debt than Hungary has, but they also have assets. And those assets represent a kind of guarantee for future lenders that this country is able to pay that back. But that's not the case in Hungary. The net debt position of Hungary is over 113% of GDP, and it is considerably worse than Greece. So the net assets, net financial assets of Hungary, the net position is the worst in EU 27. And it is something which is a long-term concern, which hinders economic growth for very, very clear reason. So conclusion number 2 is that, yes, it is possible to roll over the Hungarian debt, but it is very, very risky. And that is what we see here in the so-called CDS spreads. Now, let me stop here for a moment and refer to the title of this roundtable, because quite clearly from this data, but from other data, one can see that since January, or since end of the last year, there is a considerable improvement. In the CDS spreads, the Hungarian forint is much stronger than before, and some other numbers also show that the perception since the end of the year has changed. And I think, and I will certainly not saying anything particularly new, that has something to do with the changed rhetoric of the Hungarian government. The Hungarian government has started to change the rhetoric in December, and markets appreciate that, just as expected. However, my personal opinion, and I'm on record for saying that already in December, that this is all masquerade, this is all cheap talk. In my opinion, and of course I can't bring evidence here, it's an interpretation of the facts which are known by everybody in the room, but my interpretation of facts is that the Hungarian government does not have the slightest wish to agree with the IMF. They are playing on time and they don't want to agree. Markets don't see that way. Markets take the simplistic view. Markets believe that the Hungarian government must be sensitive and they must be willing to talk and negotiate with the IMF, and Hungary is going to get the money what it needs. That's not my opinion, but that's certainly what the numbers are showing. We will see. Conclusion number 3 is that it is not only risky to roll over the debt, it is also very, very expensive. If Hungary is borrowing in foreign currency, in euro, for example, then the difference between Hungary and the Czech Republic is about 700 basis points. It's 7%, to make it simpler. It means that everything what we invest, what we borrow, we have to pay back with a 7% interest rate. Simply, there is no investment opportunity in Hungary which can yield 7% in euro terms. This is not novelty. Back in 1995, when Mr. Bokros was the finance minister, he said, amidst very similar circumstances, that the best possible investment in Hungary is to reduce the debt. Any new investment, hoping that it will yield over 70% in euro, is just illusion. So that is very expensive. And it is not just a long-term problem, that long-term it is unsustainable. We also have a short-term problem. And the short-term problem is that Hungary is full of hot money. Why? Because of these very high bond yields. So in a world when savers in the United States or in Europe are calculating on a 1% interest rate, then of course they are looking for more attractive investment positions. And Hungary is a great place. Even here at the height it was 10%, but even today, when everything looks going in the right direction, it's 8%. Of course, people are willing to buy Hungarian bonds and finance the rollover of the debt. But it is very, very costly. And the only way how it is happening is that the National Bank is forced to keep this interest rate very high. The moment the National Bank would reduce the interest rate, all this money would fly out from the country in 24 hours. And of course, and that's my last point, that brings us into a situation where the real rate of interest is extremely high, 2%, 3% above inflation. So that is something which kills economic growth in the long run. So we are in a trap, and honestly speaking, I don't see any way out of this debt trap. That's the problem, and I hope that Ivan was not right when he was arguing that Hungary is going on purpose into a default. I hope it is not true. I hope this is not what the Hungarian government is really planning to do. But I agree that from the present economic situation, there's just no way out. There's no economic growth. Of course, and that's the positive message, if there is no way out, then we can stay where we are. And well, Hungary is not a very, very poor country. Others are going faster, but you know, we can stay, we can continue to live at this standard, at the present level of the standard of living. And well, it's not an optimal thing. It's not something we wish to have, but that's something sustainable. So, and the final point, which is a consequence of the unorthodox policies, that if the government is, for any reason, is pushing really the banking sectors and tries to put the adjustment burden on the banking sector, then what we get here, the result is the banks are unwilling and unable to finance economic growth. So that's the future. And again, if you look at the latest numbers, these are last year numbers, although they come from the European Commission material issued last week, so that's the latest what we have. Again, we see that the flow of new credits to the private sector, so the business plus households, Hungary is the second worst country again in the European Union. In every decent country, there is some nominal increase of new lending. So these countries from Greece to Malta and UK, everywhere there is positive nominal growth of new lending. And apart from Luxembourg, which is a very special banking place where there is a 42% decline, Hungary has 19%, had last year, 2010, sorry, 90% decline of new lending. Probably this year numbers are even worse. So how can we expect economic growth from the banking sector when they are forced to squeeze new lending? So let me stop here, and I hope we will have some discussion around these subjects. Thank you.
Thank you very much, all of you. I would like to give each of you the chance, if you want, to react immediately to anything your colleagues said. Ivan?
I mean, I think we agree on a great number of issues around this table. One point I would like to make that I wish I could share was his optimism that sovereign default is nowhere near the Hungarian situation, and I think I would like to go back to the data what Peter presented. I mean, the yield on Hungarian bonds are excessively high. Again, I'm not an expert on this, but I keep reading in the literature that any yield over 7% is unsustainable, and given the low growth potentials of the Hungarian economy, it's probably even less sustainable. So, I just wish a default would not be a realistic possibility. I mean, just to take up the challenge, Peter posed at the end, I indeed published a little provocative article in HVG, suggesting, in fact, the editor picked out a sentence from my paper and said the Hungarian government is playing for default. But the paper basically said that the Hungarian government is having a policy which would be consistent by planning for a default, probably assuming that the default might be inevitable. And if one wants to, I had to make sense of a number of measures what the Hungarian government was making, and that seemed to have been indicating that they were considering seriously that a default can happen, and therefore it's not inconsistent one of Peter's points, right? I mean, why playing with the IMF if all what you do is to delay the problem, right? You quiet the markets, but you don't really make the concessions what the IMF wants. And that is also was part of my article's argument, that what I have seen reasonably consistently, though there are inconsistencies, I think, in the government policies, but what I saw as reasonably consistent policies to make some careful decision that the default is happening then it would be more acceptable to the government. Right now the default would be far too early. When would it be more reasonable? And that, again, I think consistent with Peter's data, if the national bank is under the control of the government, and therefore the national government cannot prevent an inflationary policy, which would be the right policy if you try to manage a sovereign default. Therefore, you need, right, a central government which plays that game. So
Central bank.
What I did, yeah, the central bank. And right now, the central bank, of course, will not play that game because it keeps the interest rate high and therefore keeps inflation low. And the default policy would require a higher inflation policy. Well, of course, I cannot read the mind of Hungarian policymakers, and I probably have much less information than most people in this room. I don't know the characters, I never met them, and I cannot read their minds. But these indicators, that it makes some sense to me. It seemed to be a strategy to prepare a possible default, probably taking the possibility of default more seriously than Laszlo believes, but making a number of measures which tries to delay the default, to time it at a time, for instance, when you can call earlier elections just before you default, and then you default once you have the central bank under your control. Therefore, you can have a reasonably well-managed default, hoping, right, that within 4 years with the new government, you can put your economy back in the growth trajectory. I am not suggesting this would be a wise policy, and I think, again, Békési recently wrote an article arguing how bad a default would be for Hungary. It's probably right. given the Hungarian economy does not have the kind of characteristics what Argentina, for instance, had. Anyway, these are just my brief reactions. And by the way, people want to ask questions from me. Please take into account that I'm a very old man and I don't hear very well. So please speak very loudly if you want to ask questions.
Yes, I have bad news for you. Argentina is not a member of the European Union. Hungary is. And that implies that our sovereignty is to a large degree gone. So it has been conferred to a number of institutions and a number of accounts, including fiscal policy. We no longer have the freedom Argentina has. Also, another bad news, that the export ratio of Argentina is about 20%, Hungary's export ratio is 80%. So we cannot play. Also, we do not have soybean. So we tried, but we did not succeed. So including cotton and oranges and a number of other things. That was one of the things we tried and never worked. So that is one thing. Second, economists are, well, not just involved in the dismal science. I've been told by my former professor Tibor Erdős that we are also dismal persons because we actually enjoy periods of crisis, because then is the time when we have something to study and can come up with new theories, which is true. So now we have a great time, and I mean, how vicious we are that, I mean, it was not the economist or someone else in the Nezapon Institute. They were making a study of what happened to those governments which rescheduled, and 30 out of 30 were toppled within 2 years' time. So I don't think it is a good message for a government which conceives itself to be somehow the bastion of changes that are yet to come for a decade. And for this reason, my hunch feeling would be, I also cannot read the mind of the Prime Minister and the rest, but my hunch feeling would be that this is a warning sign. It's a writing on the wall to anybody who would be considering. I mean, we can talk about that, but I would advise not to talk about that. I mean, if I'm not bankrupt, then saying, okay, but you see, I don't have money, and also my card is, I better ask Doro for 1,000 forints in front of 100 people and also the cameras. I mean, it does not improve my image as a solid business person, right? That anybody who has a problem will can come and ask questions to me. So for my taste, I mean, talking about bankruptcy at the time when nothing is indicative of that is simply bad policy and also bad management of the debt. So I would suggest simply stop talking about that in the public. I mean, we can always think about that we can always speculate. I mean, we do speculation vis-a-vis one another, I mean, about friends and lovers and members of the family and all that, but not necessarily in the public, and I would very much caution against that because I simply do not see that. The third, this kind of story is that actually, well, perhaps this is bad news or good news, everybody can decide. But in the Hungarian economy, credit and especially the rate of interest doesn't really matter. And it can be long, but I just am telling you. Major debtor is the state. We had the graphs of Peter, so that's, you have all the numbers and the orders of magnitude. The biggest debtor is the state. State has never been stopped by its spending by considering the rate of interest. Right? Big business, as Peter just said, is raising money on the international monetary market. They couldn't care less than prime rate of the national bank. Small business, anybody of you who have seen a small business person, never ever would they go to the bank. If they went, they would never be given money. So in a way, I mean, the rate of interest is something for fiscal authority and the monetary authority to play a bit around, whose number will be there, whose books you are showing the deficit, but actually it does not have an impact on the economy. Anybody who tried to show that was miserably failing on anything, not even the interest rate, not even the exchange rate, not even on the exchange rate, not even on the price level, let alone the propensity to invest, let alone the propensities to save. The unemployment rate has a much bigger influence on propensity to save, because the biggest savings rate in Hungary were at the time when the unemployment rate was skyrocketing in 91, 92, 93. So my feeling would be that that is not a sort of a decisive component. Of course, you are absolutely right that given the financial conditions, the National Bank of Hungary does not have the room to set the rate of interest the way they wish. Somebody should tell the members of the Monetary Policy Committee that in a small open economy this is the case. And yes, maybe two technical points, that this yield on bonds. Any of you who's interested should go over to we have a large number of banks around and ask what is the yield of the Hungarian T-bill. It's about 7.2 or 7.5% in forints, not in euros. That's a world of difference because we have 5+% inflation. Go to the bank and check what is the yield. Anybody who has a possibility for 7% investment in euros would get 10% of the yield from me. So I'm very much interested in this type of investment. I have yet to find it. Two more points on Turkey. That was a very interesting parallel, where the Hungarian government is playing on time. Now, in very shortly, I mean, we are great friends and relatives in the Turks with a number of ways. But there's one tiny little problem. The Turkish economy has been growing by 7-8% for over 2 decades. And at the time when they started to negotiate with the IMF, it was realistic to expect that once the subprime crisis will have gone, Turkey will be back on the growth track. Everybody will buy the Turkish bonds because of the excellent growth prospect of that country. And I can tell you what about 2 hours about how great the country is from the investor's perspective. There are a number of, we do know the Kurdish problem and human rights, but that's not a concern for the financial investor. From the financial investor perspective, it's 7-7. So for this reason, the Turkish government did have the leeway. Now, for the reasons both of my colleagues will explain, the Hungarian government does not have the leeway. I wish, I mean, they were betting on that in 2010 and 11, that growth will come. Why? Because it has to come. And why does it have to come? Because we are in government. So it hasn't come. So once, I think now is the time to take account of the facts that the growth is not coming per se. If it's not coming per se, then buying time for what? For paying a higher price, for signing a worse deal with the IMF than we can sign now. I don't think it is a very promising strategy. And finally, that could be very technical but very simple. We have a thing called Basel III. Basel III is a new regulation of the banks, capital adequacy regulation of the banks. That actually squeezes the banks and limits their activity to lend whatever they are doing at least in 2012 and 13. That's a given. That's a good idea at some point, but a very bad idea from the point of view of countries like Hungary, where bank lending would be a good thing for medium business, small medium business to flourish. That is unlikely to happen. Whatever the Hungarian government or the central bank or the fiscal authority or the IMF is doing, because Basel III is superimposing itself on the working of the banks. And for this reason, I mean, this type of channel of accelerating growth is not around. What is around? I mean, anything but the credit channel. So, I mean, returning to a degree of calculability in management, having smaller taxes, a more transparent system of taxation and regulation, giving up what is called the unorthodox measures of improvisation. I mean, that would seem to be sort of trivial to me, and one does see improvements. If you think about it, you cannot just forecast the current bond yields forever. I mean, I recall, I mean, Italy had a bond yield in January in the range of 8%, and now they have a yield of 3.5%. Mr. Monti is a great man. I'm a great admirer of Monti, but he did not have the time to do that many good things for the Italian economy, so as to get down from 8% to 3+% in terms of the yield. So that can happen, and I would think that if a kind of sensible, coordinated, well-communicated set of policies are being launched, then yields are coming down, financing problem is over. That problem that Peter was talking about is solved, at least for the short term, not for the 10-year perspective. That is what I meant, that problems remain. But for the coming 2 or 3 years that is settled, growth can come back from different other sources, such as more employment and innovation and all the rest, provided the European economy continues to grow. And then that would imply what a growth of whatever, 2%, 2.5%. That is already something in which public finances can be managed in an orderly way, and then you can move along.
I try to be short and not to exploit the patience of the public. 2 points, and one is slightly in a debating tone. Ivan was talking about the low level of employment in Hungary, and this is a recurring subject. And if we try to make sense of the past 18 months, what the government did, it was indeed a policy to force people to work. Basically, the idea was that if we cut social spending, we create a little bit of inflation, people will have less money, and they will be forced to work. That was the logic. I don't think that this was a right analysis. I don't think that the Hungarian problem is that there is not enough employment in terms of hours worked. If we look at the numbers, we'll see that in terms of total number of hours worked in Hungary, Hungary is in the leading group of the European countries. So effectively, the Hungarians are working a lot. Those who are working, they are working 12 hours and 14 hours and so forth. It's another matter that we don't have part-time employment, and therefore we don't have such high employment numbers like in Netherlands or in other European countries or in the US, where a lot of people are working part-time. But that's in terms of work, Hungarians do a lot of labor into the economy. The problem is that labor productivity is very low. So Hungarians are working, and they are working very inefficiently. And that's the problem. And that needs to be addressed. And my belief is that the side from which this problem needs to be attacked is on the capital side. We have to have a much higher concentration of capital to make labor productivity higher. And it's true for agriculture, it's true for the service sector, basically. And not so much manufacturing, because manufacturing is properly equipped. That's the subsidiaries of Western multinational, that's okay. The productivity problem is in agriculture and in the service sector, and in the state sector, which is huge. And that needs to be addressed, but that requires a total different philosophy from what the present government was doing, or actually what the previous governments were doing as well. So in that regard, I don't see much difference. So that's the first point. The second point is the likelihood of default, of collapse, or bankruptcy. I would like to mention one thing which has been forgotten in the Hungarian debate. Lastly, you also mentioned 2008, when Hungary was really very, very close to bankruptcy, and Hungary turned to the IMF and the European Union at that time. I did some research over this period. Actually, I spoke to a lot of participants. And from the benefit of hindsight, the picture is different. It turns out that what Hungarians at that time perceived as a punishment of the markets for the Hungarian deficit, for the wrong government policies of the past 8 years and so forth, was actually not. What happened was a sudden freeze of the international monetary markets. It was really an external shock. The Hungarian government, the decision makers, felt blame. They blamed themselves that, well, we have a problem because we were pursuing the wrong policy. But actually that was not the reason. What provoked the crisis was the international problem, the Lehman crisis, and right after Hungary, many other European countries were forced to do the same thing and go to the IMF, Poles and others. So, and why this is relevant? I think it is relevant because Laszlo is right that if nothing happens in the international scene, everything remains as calm as it is, then we have a good chance to muddle through, and there will be no collapse. The problem is that if something happens again on the international financial markets, and it could be the Greece situation, it could be Iran, it could be many, many other things, it could be China even, then we will be again in a very, very deep trouble, and that is the moment when, in spite of the huge reserves, suddenly financial markets will be frozen again, the so-called sudden stop, and there will be just no money. And it can happen that on Tuesday the Hungarian bills are oversold, and on Friday nobody's going to buy that. And the next Monday nobody's going to buy that, and then the rumor spreads around that Hungary is a basket case, and the country can collapse in 2 hours. So the international risk is enormous, and in such a situation, having twice as many reserves actually doesn't help. Back in 2008, it was argued that the problem was that Hungary had too low international reserves, and this was the reason why the forint went up to 319. Recently, at the end of the year, Hungary reserves were twice as high, and the forint went even further to 321. So the real concern is that we are ill-equipped to resist a major international storm, and that can happen anytime. I think that's the real problem.
Okay, on that pessimistic note,
Optimistic.
this is what I invite the audience, and if I could ask to identify yourself when you talk. I don't know, I said Brigitte, now I identified you.
Okay, I'm Brigitte Young.
And please speak up because the acoustics is very bad in this room.
I'm Brigitte Young, I'm a guest professor in IRIS, and I'm from Germany. My question is first on a technical point. Laszlo, when you said Basel III in terms of the capital adequacy is a problem, but it only comes into effect 2019. By that time, we have the next banking crisis already. Is that not true? So that is one of the problems. It is not going into effect next year or whatever, but the individual is 2019. And the question to all three of you I have is, where do you think the growth is coming from? In terms of, is it services? You mentioned that in manufacturing, I believe one of the biggest employer is Audi, really, in Hungary, the German car manufacturer. So what is it where you think in the near future there could be the growth potential? Is it services? Is it agriculture? Is it manufacturing? Where is it? Thank you.
Okay, you, please.
Yes, my name is Charles Kovac, and I'm here in a private capacity, but I was a banker for many years, and I have some experience in sovereign debt. I would just like to suggest that why haven't you mentioned or asked the debt service ratio of Hungary, which is quite good, because the fact that I see that there's agreement on that there's no great problem with the debt to GDP ratio, and I agree, it's not an important ratio when you analyze a country, but it's the one number that politicians and journalists can understand. It's good television, so people talk about it. 80%, 120%, 240%, whatever. What matters, however, is the debt service ratio and the maturity schedule of the debts of a country, especially the foreign currency part of that debt. And in this situation, Hungary is very well, actually. The annual installments are not that much. Where there's vulnerability is the short-term debt, where if the foreign banks or lenders refuse to roll it over or refuse to make new loans, then the installments double. Then it gets trickier. And then this is my final point, is that the tendency of banks and other lenders to roll over is a matter of confidence in the borrower. And this is where, again, maybe all three of you could say something as to why perhaps could be more explicit about why there is no confidence in the Hungarian economy, the government, the financial system. I mean, there are a lot of things have been happening here over the last 2 years and before that. And but I would suggest that these have a direct bearing on what is happening here. And unless confidence is restored, financial, domestic, and consumer confidence, then I don't see how there's going to be any growth whether next year or the year after.
Peter, could you please speak up also, because I think the people in the rear end of the room have a difficult time. Maybe stand up.
Okay.
And identify yourself, please.
Thanks. So Peter Molnar, Center for Media and Communication Studies here at CEU. And my question is that in what ways and to what extent you think the constitutional crisis influenced all this? In other words, if the government would be very clever and effective in its economic policies and would not mess up private contracts, would it be all fine, or would the credibility of the country still be undermined by the constitutional crisis, by restrictions to all sorts of freedoms, and I don't go all the way down the list? Thanks.
Okay. There's a question here.
My name is Piotr, I'm from the history department at
Please
CEU.
stand up. I mean, the acoustics is really bad.
I'm just a question, because you were considering two scenarios for the future of Hungary. One was the sovereign debt default, and the second was this cumulative process of coming to terms with the IMF. But there is a third scenario, which is let's say like a Portuguese/Greek scenario, which is to resign and let some expert Goldman Sachs associate government to do the dirty job of introducing our certain measures for you. And paradoxically, I mean, I just have this impression that I mean, like, it would be commonsensical for the current prime minister to consider such a step while he's still a fairly popular politician. I mean, to resign right now and to have come back in the with the halo of the savior who was. So how about this scenario?
Other people would like. Okay, then I give back the word to the panel. I start with you now, Peter. I mean, only if you want to.
Yeah, okay. I don't address all issues. Growth potential. Of course, we have to make a difference between high productivity and the possibility to increase productivity. And that's why I'm saying that in manufacturing sector there is nothing to gain, because the productivity level is as high as it can be. So the growth should come from those sectors where productivity is low. And agriculture is one, and the service sector is other one. So I think a sensible government should generate economic growth by liberalizing these sectors, agriculture first of all, but also the real estate sector and many others, because that's where productivity growth can come. That's my opinion. On the caretaker government, I leave the two other issues for others. Of course, it's a logical model to assume, but I think a caretaker government in Hungary is very, very unlikely to arrive before a financial collapse. Once there is a financial collapse, so Hungarian households go to the ATM machines and they want to withdraw money from that, and there is no money in the ATM machine, that's the collapse, that's a sign. Then there will be a caretaker government. And once there will be a caretaker government, they will take care of the constitution. So the present parliament will restore the constitution as well. But not until that. And that's really scary and frightening. And I don't know what will be better, to live with the present constitution or have a financial collapse. I leave it for everyone to decide.
The usual optimism coming from
Well, I think we should remain with the facts. I mean, I keep on hearing, for instance, there is no money in the system. We see the European Central Bank pumping 500 billion euros in the system, out of which 450 is being parked in the banks. That is simply untrue to claim that there is no money in the system. Similarly, it is untrue to claim that there is no money in the Hungarian system. There is a threat of getting money. I mean, the problem with the Hungarian banking system is that they have a lot of assets, and they have a minimum willingness to credit, in part because of lack of calculability, which is even more of a trouble for them than firms in the real sector, because they have much less opportunity to, what we call in Hungarian, to cost it away you just don't see. I mean, you don't pay taxes and that, so in a way, one way or another, you can cover expenditures. They can't do that. Also, I mean, they do not have that many very good objectives. If you think put yourself in the shoes of a banker when the United States is already downgraded and France is being downgraded, it's not so trivial where you should put your money into, because yes, it is true that you have certain governments which are paying high yields over the bonds, but these are very risky governments which may not survive tomorrow. So it's not so simple. I mean, any of you have studied risk assessment and say, okay, profit matters, but risk also matters, and we should find a kind of equilibrium. And also, if one thinks about Basel, there is already a preparation. They made it very unclear, very clear. They made, I mean, several of the bankers have already made clear that they are already starting the provisioning and also applying rules that previously didn't used to be applied. One can ask to what degree it is psychological and to what degree it is real, but it is in the making, and therefore I would generally think that the problem with the banking system is that they are sitting with a lot of money and they are making very little out of that, and that's a problem which cannot be solved just by pumping more money in the system or just pushing down the rate of interest. It will be of even less avail. That's exactly the Japanese way to decades of stagnation that should not be replicated. I don't think we are in a Greek scenario in any way. It's a completely mistaken parallel on any account. I can talk 60 minutes on that, so I won't talk. I mean, I will just look at Dora, she was already a little edgy because of my statements. It's 60 minutes, nothing, not a single thing in parallel, nothing, completely nothing in parallel. Both of us are members of the European Union and otherwise, and Homeros is being taught also in the Hungarian schools, and otherwise there is nothing common with the two countries. Yes, on the constitutional crisis, I think it's a completely different ballgame. So what we have in terms of financing and economic policy making is related, of course, because I mean there is a totality, social, economic, political, psychological, constitutional, and whatever. But I think it's a different ballgame, and the economic part of it is complex enough, as Peter has explained in great detail, because of the numbers, the arithmetic, because of the difference short-term, long-term, and the complex financing techniques in it. So I would think that the constitutional crisis, of course, exacerbates the situation. And yes, the very final point on the caretaker government, it can happen if I mean, although you really have to feel yourself sort of in a hopeless situation. But as long as, I mean, the governing party was winning all the elections what they had until now, 53% was the weakest standing they were getting, in a situation in which economic growth was barely 1.5 percentage point per year. Barely. It was actually less. Last year it is going to be, what, about 1.3, 1.4 for 2011. This year maybe 0.3. So in 3 years it won't be half of the loss that was lost during the Weimar government. That's not a very strong economic standing, and despite of that, I mean, the governing party seems to enjoy a certain popularity, and this enchantment, which is obvious around, is not showing up to anywhere. It's turning away from politics, Verdrossenheit, and that is what we see, and that is not a good sign for anybody except the governing party, but that is happening. But that is happening, but unless, I mean, somebody is pushed to the corner, why should they give up? I mean, perhaps I'm wrong, but I would think it's one of the few assumptions we economists tend to think about politicians, that they are greedy, they want to keep their power, whatever is the consequence, and this assumption doesn't seem to be as abstract as many of the assumptions we economists are employing. I don't understand human nature. Thank you.
Let me just say that I don't like the sort of war between disciplines, and particularly dislike the war between economics and sociology. But let me just say here that there is some difference between what the way how economics do their business and how sociologists of my kind are doing their business. I actually don't read virtually any sociology anymore. I only read economists because they are much more interesting than sociology style. But nevertheless, the difference in style is that economists solve problems, right? And they are responsible people, right? And I think that's what Lotzi said, and I admire this. That in public we have to speak in a responsible manner and not to make sure we are not creating panic. Well, sociologists of my time are troublemakers. We are very irresponsible, right? And we try to find prophecies which hopefully will be self-defeating prophecies, right? You gossip it out, the worst possible news, and this way you try to prevent that the worst news will become real. Now, having said that one, actually, I think I agree with my colleagues and people who made comments that, of course, one big issue of Hungarian economy right now is the problem of trust. And a lot of this lack of trust has to do with fluctuating, unorthodox economic and other policies by the Hungarian government, like the attempt to change the independence of the central bank, probably the most crucial issue as far as the economy is concerned. And I think this is a big deal. And I think Peter's chart was beautiful, right? As soon as the government makes some gestures that the market feels a little more comfortable, then suddenly the yield is down from 10 to 7%. And that's 8%, not quite 7%. Yeah.
This afternoon, 7.24 was this afternoon.
How much?
7.24.
7.24, even better. Right. So that has a lot to do. But on the other hand, I think there are some problems with the fundamentals, and this high yield also reflects fundamentals. And by the way, I agree with Peter. I probably was overemphasizing the importance of underutilization of labor. It's also a problem of capital. There is not sufficient amount of capital. I only want to add, in my self-defense, I would have never suggested that the way how to solve the job problem to cut benefits and force people to work. My point was an old lefty point. What is lacking are jobs, and you have to create well-paying jobs and to get people back to work into well-paying jobs. Now that brings us to the question, where on earth those jobs can come from? And well, as a sociologist, I don't have the answer. I'm just reading Paul Krugman every week in New York Times, and every week he tells even Obama that he's not spending enough to create jobs. And I like hearing what he got to say, and I think this is of relevance for the European Union. And I wish that Margaret Thatcher would read Angela Merkel would read that she does. I really don't know where it would come from. And there are, some basic problems, and the demographic problem is one important one. And I don't want to open up a complete new agenda, but I think for many European countries, and among Hungary, probably one has to rethink the immigration policy. I think a massive dose of migration, without a massive dose of immigration, very difficult to see how a country in the demographic situation Hungary is in and has been heading in this direction since 1960 consistently, how on earth it can dig itself out and to create a one-to-one ratio between the economically active population and those in pension. The solution is not, obviously not, to cut pensions. The solution is to create jobs, to create incomes, to create taxes, and to be able to provide proper pensions to people. But that will require a change, demographic change. And I really don't think this can be achieved in a country with this demographic profile without a massive dose of immigration, which of course is a very, very hot potato politically, and would call for major issues. issue. And finally, to the question whether the Prime Minister should resign and return, and can return and go in. Well, Prime Ministers don't resign when they have two-thirds majorities in government. It is not another situation of Greece or Italy. I really don't see the scenario as the Prime Minister quitting with a two-third majority when it actually has the majority strong under its stump. It's a very disciplined majority what he has. So I don't think this is quite realistic.
I just want to add one point to Laszlo's last comment when he said that the government enjoys popularity and the by-elections are all going for the government. I think there's an important fact which many Hungarians, when we live here and experience daily problems and listen to friends and so forth, we stand to neglect. And again, these are numbers. During last year, 2011, real wages in Hungary increased by 4 or 5%. Well, depends. We don't have the final numbers out yet. And that, of course, means that people are happy with the government from the perspective of their pockets. Unemployment basically remained unchanged. So those who were unemployed last year, they are still unemployed. Those who were unhappy, they are still unhappy. But the large segment of the population actually enjoys the benefit of this. Pensioners are a large segment of the population, very active politically. They were also able to maintain the real value of their pensions. So there is little wonder that the government is popular. The only problem, and again everybody knows in this room, that this welfare year was financed from the confiscated private pension funds up to the order of 10% of GDP. The real question is next year, where is another 10% of GDP available for making voters happy? And I don't want to give suggestions and ideas for the government, but there are not that many low-hanging fruits anymore, and that will mean a new situation for next year or this year already.
Okay, ladies and gentlemen, our time is up. I really thank the panel for a very, very interesting discussion and roundtable. I hope you enjoyed it as much as I did. If you want to meet speakers one by one, we have a small reception outside. Please join us. And thank you all for coming.